Welcome to Lecture 9. In this lecture, we are going to complete Chapter 14, the one that we have started on Lecture 8. Let me first make a quick recap of the different types of long-term liabilities, which is the topic of this chapter. We agreed that long-term liabilities are those that are due for a period of more than 1 year. So they are obligation for the company, and the company will have to meet them after 1 year. So they are classified as non-current or long-term liabilities. There are three types that we are going to study, which were bonds, long-term notes payable, and pensions and leases. We already started to discuss bonds last lecture, so we are going on this question to make a quick recap of the most of the theoretical concepts related to bond that we discussed on previous lecture. So you have statements, 7 statements, and you're required to complete them. Number 1. Includes specifics such as the issuer's name, the bar value, the contract interest rate, and the maturity date. So we agreed that if you want to invest your money, you can go to the stock market and buy bonds. If you're going to do that, you're going to receive from the issuer company a piece of paper that we call bond certificate. This bond certificate will include certain information such as the name of the company that issued those bonds, the bar value, the interest rate of that bond, and the maturity date. So all these data will be written in a paper called bond certificate. So that was number 1. Number 2, also called the face amount or face value, and it's paid at a specified future date known as the bond's maturity date. So when I'm going to buy that bond, I will lend the company certain amount of money. This certain amount of money, we call it face value or face amount, or also it's called bar value. So this stands for the definition of bonds bar value. So the company will borrow it now from the public, from the people, from the investors, and then will have to repay it back to the investors again back at the maturity date. Number 3. The bond the issuer pays the interest rate specified in the certificate. This interest rate is called. So when I'm going to buy the bond, I will agree with the company on a certain interest payment that I will receive. This interest is calculated based on an interest rate that we call coupon interest rate. So we'll call it company or coupon interest rate. So this can equal to the market interest rate or can be higher or lower than the market interest rate. So number 4. The real interest rate that the bondholder, if he or she invested their money anywhere else in the market, is called. So compared to the other interest rate that's found in the market, this is we call real interest rate. So we call it market interest rate. So we have two interest rates, coupon interest rate and market interest rate. Coupon interest rate is the one that is written in the bond certificate according to the agreement between the issuer company and the bondholder. And we have another interest rate prevailing in the market in other places if I want to invest my money in buying other bonds. So this is called market interest rate. Number 5. Cash interest expense paid by the issuing company to the bondholder is calculated. In order to calculate the interest that the bondholder will receive, we need to multiply the bar value of the bond times the interest rate times the period. Okay. Number 6. Cash interest paid is calculated. Okay, so when we calculate the interest rate, mainly we will do our calculation on an annual basis because the coupon interest rate that is given, that is written on the coupon, is annual one. And then if we are going to pay it monthly, then we are going to divide it by 12. If you are going to pay it every 6 months, then we are going to divide it by 2. If you are going to pay it annually, then you will not divide it by anything. We'll leave it like that. If you're going to pay it quarterly, then you are going to divide it by 4. So first we calculate it annually, and then according to the payment, which could be semi-annually, quarterly, or monthly, we are going to make our division. So we're going to include the time here. 7. If the company interest rate is equal to the market interest rate, the bonds are said to be issued at. So if the company that will issue the bond will offer interest rate equal to the one at the market, then we said that bonds are issued at its bar value. If the market interest rate is higher than the bar value, then the company will have to discount the bond, so this will be the issuance of bond at discount. If the market rate is lower than the coupon interest rate, then the issuer company is at a great advantage. So this will make the company sell the bond at a price higher than its par value. So we call it bond issued at premium. Let us now discuss this exercise in order to make a quick recap of how we recorded the bond transaction. We have a company, Moss Company, which issues bonds with a par value of $90,000 on Jan 1st, 2011, and the bond's annual contract rate is 8%, which we call it the coupon rate, and interest is paid semi-annually, means 2 times each year, on June 30 and on December 31st. The bonds will mature in 3 years. This is the life cycle of the bond. You are required first to prepare journal entry to record its issuance, as well as to record the first semi-annual interest payment recorded by the company under the following 3 assumptions. We will start by the first assumption, which is market interest rate is 8% and the issuance price equal to par value. Please note here that the interest rate of the market, the one that is prevailing in the market, is same as the interest rate that the bond will be providing to its bondholders. Accordingly, the company will be able to issue the bond with a price equal to its par value. So this means that the issuance price equal to 97. So now the company will need to record this entry, the issuance entry. If you remember, when the company will issue a bond, this means that the company will be in debt. So the company will increase its liabilities by crediting the bonds payable, and in return for that, the company will receive cash. The cash of the company will increase, so we are going to debit cash. So the entry that would be like that. We are going to debit cash by 90,000 and credit liabilities bonds payable by 90,000. This is the first requirement. Second requirement, we need to record the first semi-annual interest payment recorded by the company. So now the reason for asking about the first semi-annual interest entry is that the first entry to record interest expense will be like the second entry, will be like the third entry, will be like the fourth entry. They are all the same. Only the difference will be the date. So here the company will be paying interest 2 times a year. We need to calculate one of them because all of the rest will be the same entry. So if you remember, in order to calculate the interest, we need to multiply the interest rate, the 8%, the coupon interest rate, not the market one, the coupon, which is 8%, times the par value, which will be 90,000, times the period. Here will be half of the period. So this will be half of a year. So we are going to calculate the interest expense. It will equal to 3,600. So the company is going to record this on June 30 as an increase in its interest expense, so the company will debit interest expense, and decrease in its cash, so the company will credit its cash. So this is the first case. The first case is that the market interest rate is 8% and the coupon interest rate is also 8%, so this will make the company will issue a bond equal to its par value. Now let's discuss the second assumption and the third assumption, which is bond issued at discount or bond issued at premium, in order to understand how can we do the amortization of bond discount and the amortization of bond premium. So that was all regarding the case of bonds discount, bonds premium. So let us now start by the case of amortization of bond discount. First, we need to know, to remember together, the bond discount results from what? It results when a company will issue a bond and those bonds will have an interest rate lower than the one in the market. So for example, if the prevailing interest rate in the market is 10%, the coupon interest rate of the bond will be lower than 10%, maybe it will be 8%. So in this case, the investors will not be motivated to buy this bond. Why? They should go to this company and buy the bonds, and they will have the possibility to invest their money in any other bond and will receive at least 10%, which is equal to the prevailing market interest rate. So in order for the company to attract investors to buy their bond, Knowing that its interest rate is lower than the market, the company will reduce its issuing price. So instead of making its issuing price equal to the one in the market, it will issue the bond with a price lower than the one in the market. So this will create what do we call discount on bonds paid. So now this amount, the company will record it in a contra liability account, which is called discount on bonds paid. So actually this amount, which we treated as bond discount, is actually increase in the amount of interest expense that the company will be paying or will be recording to the bondholder each period. So the company will do what? Will amortize. Amortize mean it will spread the amount of this discount of bonds payable over the lifetime of the bond. So each amount, it will increase the amount that it will record as interest expense. Because we had discount on bonds payable, which is the difference between the face value of the bond and the market value of the bond. So this difference, the company will treat it like a loss, like an extra expense it will have to record each period. So this is the value of discount on bonds payable. The company will amortize it. The meaning of amortize it, it will spread it. It will record it over the different period until it's reduced to zero. So this will make the amount of interest expense recorded each period higher than the amount of actually cash payment as an interest made to the bondholder. Let us discuss that using numerical in the following slide. So let us now discuss this practical exercise in order to understand the meaning of amortization of bond discount. We have the same exercise that we solved before, which is a company that issues bonds with a par value of $90,000 on Jan 1st, 2011. The bond's annual contract rate is 8%, so this bond will offer to its holders 8% interest rate, and this interest will be paid semi-annually, means 2 times each year on June 30 and December 31st, and the bonds will mature in 3 years. So you are required to prepare an entry to record the issuance of the bonds, as well as the entry to record the first semi-annual interest entry recorded by the company. Please be aware that the first semi-annual interest payment entry will be the same as any other entry we will need to record the interest payment, because it will be repeated by the same amount each 6 months. So we are only going to do one, because any journal entry that we'll be recording will be the same as any other interest expense recording. So you need to do those two interests under the following assumption, that now the market interest rate is 10% and issuance price equal to $85,431. So now this means that this bond will offer to its bondholder only 8% interest. However, if the bondholder wishes to invest his money in buying any other bond in the market, he will receive a higher interest rate equal to 10%. So the market interest rate is 10%, while the interest rate of the bond is only 8%. So bondholders or investors will not be motivated to buy this bond. So what will company will do? It will reduce its price. So the issuance price in the market, the selling price of this bond in the market will be reduced below the par value. So the par value is 90. It will reduce it to 95,431 in order to attract investors to buy it. So investors will buy bonds with 85,431, and after 3 years after the maturity date, or at the maturity date, they will receive the par value. They will receive the 90,000. So this will motivate investors to buy this bond. So now we need to record this entry, the issuance entry. So the company will be liable with 90,000 with the par value. So it will credit the bonds payable by the par value by the 90,000. Always remember that we record bonds payable with the par value. Then the company will record the cash received. The cash received corresponds to the issuance price or to the selling price. The selling price here is 95,431. So now we have a difference between the debit side and the credit side. This difference represent 4,569. It represents the discount that the company made on the bonds payable in order to attract investors to buy it. So we have 4,569. We will put it in the debit side in order to make total debit side equal to total credit side. So this amount, the 4,569, is recorded in an account that we call it discount on bonds payable. This is a contra liability account. It has a nature reversed to the nature of liability. Liability, the increase in the credit side. So this means discount on bonds payable, it will increase in the debit side. So now we need to think about the second step, the entry to record the first semi-annual interest entry. As we mentioned before, this entry will be repeated every 6 months. Why? Because it's mentioned in the problem that this interest is paid semi-annually, means 2 times per year, means each 6 months. So we need to calculate the amount of interest that the company will pay to the bondholder every 6 months. So we will apply this rule, which is we multiply the bar value of the bond, the 90,000, times the contract interest rate, not the market interest rate. We always follow the contract interest rate when we calculate the cash interest to be paid to the bondholder. So we will multiply the 90,000 times the 8% times the period. Here, this entry will be repeated every 6 months, mean half of a year. So at the end, this means that we have 3,600 to be paid to the bondholder every 6 years, every 6 months. So let's now imagine this on a timeline of the bond. It's mentioned in the problem that this bond is maturing after 3 years. So this means that its lifetime is 3 years. So let's draw a line to illustrate this. We have year 1, year 2, year 3. Each 6 months, the company will have to pay 3,600 to its bondholder, as you can see. So this means throughout the life of the bond, the company will pay interest 6 times. If you're going to count those boxes under the year, you will find that they are 6 times. How did I calculate it? I multiplied the life of the bond, the 3 years, times 2 times per year. So this means total 6 times. So the company will pay the interest 3,600 every 6 months. So it means over the life of the bond 6 times. So now we need to know, as you can see here. Okay, now we need to know those 4,569, the discount on bonds payable. So what will happen to them? So at the end of the lifetime of the bond, the company will repay back the 90,000. And now on the issuance date, the company received the 85,431 cash. So what will happen to the 4,569, the discount on bonds payable? So this discount on bonds payable, the company will treat it as an extra expense that it will have to bear because it had to issue its bonds at a discount, at a price below its bar value. So this is what we're going to do now. We need to do an accounting procedures to spread or to allocate the amount of this discount on bonds payable over the life of the bond. So we are going to allocate or spread the amount of the discount over the life of the bond. Why we are going to do that? Because this discount on bonds payable, the company is treated as an extra expense that it will have to bear each period. So we need to allocate this amount over the periods, over the 6 times, over the 6 periods. Each time the company will have to pay the interest. So we need to calculate each period. We are going to allocate how much of the total discount on bonds payable to each period. So we are going to divide the amount of amortized discount, which is the 4,569, divided by the total number of interest payments, divided by 6. So this means that each time the company will have to increase its interest expense to include extra amount, which is 762. This is the one that we have calculated here. So let's put it here on our timeline. So this means that for the first year, on June 30, it will include 3,600, the interest paid, plus the 762. And for the second interest payment on year 1, which will be on December 31st, it will have also to allocate 762 out of the total amount of the discount on that period. And we'll do the same for the rest of the 6 times. So here the company will divide the total discount on bonds payable, the 4,569, over the different periods in which the company will pay the interest. So this is an accounting procedure that the company will only do on paper. So it doesn't contradict with the amount of cash interest that the bondholder will receive. So let me illustrate this by the entry. Now we need to record the entry. So what will happen? We need to know the amount of cash that each 6 times the bondholder will receive. So the amount of cash that each 6 months the bondholder will receive will be 3,600. This is the amount that we're going to credit as in cash. This is the cash interest payment, the one that we have calculated here. So what about the interest expense? The interest expense will include 2 amounts. This, the cash interest paid to the bondholder every 6 months, the 3,600, plus the amortized discount, the 762. So this means that the total interest expense that the company will record will be 4,362, this amount. So the cash payment is 3,600. However, the interest expense that the company will have to record each period will be the total of the cash interest payment plus the amortized part of the discount. So this will make it 4,362. Then we will, in order to make debit side equal to the total credit side, we have to add in the credit side 762, the discount on bonds payable. Now we credited discount on bonds payable. Remember that discount on bonds payable, it increased in the debit side and decreased in the credit side. So now we decreased the discount on bonds payable. So when we credit discount on bonds payable, this means that we reduce its balance. So we have to reduce its balance 6 times because we have 6 payment times, until at the end of the lifetime of the bond, this discount will equal to 0. So this is how we record the interest entry. However, we are going to repeat it every 6 months. So we are going to do it only once now, but you have to know in reality that the company will have to record it every 6 months. Now, after we discussed the case of amortization of bond discount, let us discuss the amortization of bond premium. First, let us remember together what is the meaning of bond premium. This is the case of a company that will issue a bond with a carrying interest rate higher than the one in the market. So if the market offers maybe 12% interest rate, the bond of this company will be higher. The interest rate of the bond of this company will be higher, maybe 14%. So the difference between the face value of the bond, or the bar value of the bond, and the market value, the company will record it as a premium. So this is what they mean of bond premium. So this bond premium, the company will make it in order to record the excess of the face value of the bond over the market value of the one that's prevailing in the market. So now the company knows that investors will come and buy its bond because its bond will offer a market rate, an interest rate higher than the one in the market. So the company now will increase its selling price of its bond. So the difference between the market value and the face value, the company will be recording it as bond premium. So this amount, the company will treat it like a revenue. This bond premium will be treated like a revenue. And the company will use it to reduce the amount of interest expense that the company will be recording each period. So this is what we call by amortization of bond premium, which is reducing the amount of interest expense that the company will be recording each period. Now, it's very important to be aware that amortization is an accounting technique. What do you mean by accounting technique? It's something done on papers. It's not related to the actual cash interest payment that will be made to the bondholder. So it's something written or made on the paper to fix the accounting books. So we are going to spread the value of the bond premium over the life of the bond by reducing the amount of interest expense recorded each period. Let us do this using the numerical example on the following slide. So let's now discuss the case of bonds that are issued at premium. We have the same example. However, this time you are required to follow this assumption that the market interest rate is 5% and the issuance price equal to $92,700. So now we need to compare the contract interest rate, which is 8%, with the market interest rate in order to know whether we are going to issue this bond at discount or at premium. So the market only offers 5%, while this bond will offer 8%. So this means that the contract interest rate or the coupon interest rate is higher than the market interest rate. So this will make investors are more motivated to invest their money in buying this bond because they will offer them interest rate higher than the one that is prevailing in the market. So there will be more demand on buying those bonds. So the company now can be motivated to increase the selling price of the bond. So the selling price of the bond will be higher from the bar value. The bar value is 90,000. So the selling price, the company will increase it to 92,700 because it will have more demand on its bond because their bonds, they are offering interest rate higher than the one in the market. So this means that this bond will be issued at premium. So let us now record the entry of the issuance. So the company will receive the issuance price. So every time we record the cash, we use the issuance price. So the issuance price here is 92,700. So the company will debit the 92,700 to indicate an increase in its cash. Then, after 3 years, the company will repay back the bar value. So the company will record credit bonds payable by the bar value. We always, each time we record bonds payable, we include it by the bar value. So the company will be liable by the 90,000, so it will credit bonds payable by 90,000. Then we have a difference between the debit side and the credit side. This difference represents 2,700. This 2,700 is because the company issued the bonds on premium. So we will record this as credit premium on bonds paid. So that is the first step. Now we need to know how can we record the first semi-annual interest entry. So first we need to calculate the amount of cash interest that the bondholder will receive every 6 months. So we're going to multiply this rule, the same rule, $90,000, the bar value, times the contract interest rate, the 8%, times half of a year, because this will be only for 6 months. So this means that every 6 months the bondholder will receive 3,600. So over the life of the bond, this will be repeated 6 times. So let's us draw this timeline. We have here 3 years. Each year the company will pay the interest 2 times. So when you count them, you will find them 6 times. So now we need to know the amount of interest, cash interest, that the bondholder will receive each 6 months is 3,600 as illustrated here. However, this is the cash interest. Now we need to know the interest expense that the company will record because the cash interest is different from the interest expense. So each 6 months the company, as you can see, will pay 3,600. So now we need to consider the premium amount. The premium amount here is 2,700. We need to do what? We need to allocate the amount of this premium over the life of the bond. So this 2,700, the company will treat it as the revenues, extra revenues they received. So they will use it to do what? They will allocate it over the lifetime of the bond. So we have here total amount of 2,700. We will allocate it over the total number of interest payment. We have 6 times. So this means that each time I'm going to allocate 450 to the interest expense. So this 450 will be the share of each 6 months. So now I'm going to include it in each period. However, as you can see here, we are going to include it with a minus amount, not plus amount, as we did in the discount case. As you can see here, we are going to subtract it from the interest expense, not we're going to add it. So, why? Because the company now will treat this like a saving in its interest expense. It will make savings to interest expense because this is extra money that the company received in advance. So it will treat it like a saving. I'm going to reduce my interest expense. So that's why I'm going to subtract it from the interest expense that I will be recording each period. So I'm going to record this entry. The debit interest expense, I'm going to debit interest expense, not by the 3,600. No, I will have to subtract from it the amount of the amortized premium because we will treat the premium as saving in the interest expense. So we will get 3,150. Then we are going to record the cash that the company will pay. We said that the cash that the company will pay will not change. The 3,600 will be always paid to the bondholder every 6 months. So the company will credit cash by this amount. Now we have a difference between the debit side and the credit side, which will be the premium on bonds payable. So to make the debit side equal to the credit side, we will have to put the difference, which is the 450, under the debit side. So now we did what? We debited the premium on bonds payable. Why we did that? To reduce the premium on bonds payable balance. We need to reduce it until it will be zero at the end of the lifetime of the bond. We need to spread it over the lifetime of the bond. So each period we are going to allocate 450 to it until at the end it is zero. So this is the case of the amortization of bond premium. Remember that the amortization of bond premium, we do it only as an accounting procedures. Now let us refer to the other types of long-term liabilities. So far we have covered the bonds. Now we're going to discuss the second type, which is the long-term notes payable. Okay, the long-term notes payable represent another type of liabilities. In this case, the company will have to borrow certain amount of money from a single lender. So this could be bank, could be a single person, and the payment of those amount will be over a period of more than 1 year. So that's why we're going to classify it as long-term notes payable. So as illustrated here, the company will borrow money from the lender. So the bank maybe will have to make the company sign a note that to indicate that the company has borrowed certain amount of money. And in return, the company will get cash from the bank, from the lender. So at a certain period of time, the company, which we call it maturity date, the company will repay back the principal amount plus interest. So in some cases, the company will make single payment of the principal plus the interest at the end of the lifetime of the notes payable. So at the end of the maturity date. So let's take an example. If we have a certain company that decided to borrow a loan from CIB. So that was done on 2015, on year 2015. So the agreement is at the end of the lifetime of the loan, which could be after 5 years, so on 2019, then the company will have to repay back the borrowed loan. So let's assume that the borrowed loan is 1 million plus interest. So throughout the life of the loan, the company will make no payment of any principal or of any interest. It will only make it only once as a single payment at the end of the lifetime of the loan. So it will be on 2019. So when it comes to 2019, the company will repay back to the lender, to the bank, the 1 million plus the interest. This is, we call it single payment of the principal plus interest at the end of the maturity date of the notes payable. A case. However, we have another case, which is the more familiar or the more common, that no, the company will not wait till the end of the lifetime of the note payable, but rather will make payments, regular payments of part of the loan, part of the interest, part of the principal plus interest. It will make it either equal amount, maybe each month, maybe each 6 months, each year, and until it reaches to the maturity date. And at that time, there is nothing else to be repaid, because the company repaid the principal amount plus the interest over the lifetime of the maturity date, or of the lifetime of the notes payable. So we call it multiple payments done from the company to the bank over the lifetime of the notes payable. And this is more familiar, more common. So if you as a single person decided to go for a bank to get a loan in order to buy a car, you will make an agreement with the bank that you will pay the installments. You will pay on installments. You're going to pay part of the borrowed amount plus interest. You're going to do it every month throughout maybe 4 or 5 years, according to the agreement between you and the bank. So this is more common. So let's now discuss an exercise which is related to long-term notes payable. On Jan 1st, 2011, Rhonda borrows $25,000 cash by signing a 4-year 7% installment note. The note requires 4 equal total payments of accrued interest and principal on December 31st of each year from 2011 till 2014, and each year's installment is calculated to be $7,381. So, first requirement is you are required to prepare a journal entry to record the borrowing transactions at Rhonda's books. So now we have a case of an individual who would like to borrow a loan from a bank. He will go to the bank, she will go to the bank and decide to sign a note. This is a 4-year note, so this means this is a long-term notes payable because it's more than 1 year, and agreed with the bank that the repayment of the loan will be through installments. So she will have to make 4 equal installments. Each installment value is calculated to be $7,381. So now, in the first requirement, you are required to record the borrowing transaction. So on Jan 1st, 2011, what happened to Rhonda? Rhonda borrowed cash. So the cash of Rhonda increased by $25,000. So Rhonda will record this as debit cash by $25,000. On the other hand, her liabilities increased. So she will record this as credit notes payable. So the notes payable here represents the liabilities of Rhonda. Now we need to determine how much of the original loan and how much as an interest expense is paid every year out of the installments. And we will use the amortization table given below in order to determine this requirement. So now, as illustrated in the previous slide, Rhonda borrowed $25,000. This is the amount of the original loan, and will pay installment equal to a certain amount that's given in the previous slide. So we need to know each year out of the installment that Rhonda will pay, how much will go to repay the loan and how much will go to repay the interest. So we need to construct this table. As you can see, you have a table that contains 5 columns. In the first column, you're going to write down the date. The second column, the value of the loan at the beginning of the year. Then the amount of the installment paid in column B. In column C, how much will be paid as an interest. And the next column, how much will be paid to repay the original loan. And then the value of the loan remaining at the end of the period. So Now we are on Jan 1st, 2011. This is the value of the loan at the beginning of the year. Rhonda borrowed $25,000. Then we need to know, starting from the second year, how much Rhonda will start to repay. So for the first year, we are going to install 0, to write down 0 under installment paid, under part of the installment paid as an interest, and part of the installment paid to repay the original loan. And then this means that the value of the loan at the end of the first year is equal to the value of the loan at the beginning of the year, which is equal to 25,000. Why is that? Because we'll start to calculate the repayment of the loan after the first year. So we will start from December 31st, 2011. So the value of the loan at the beginning of December 31st, 2011 is $25,000 because this is the end of the previous period. So now we need to know how much Rhonda will start to repay part of the loan. So it's given in the previous slide that the total amount of installments is equal to each year 7,381. So we are going to put this amount each year because it doesn't change. It's given in the problem. Each year Rhonda will make 7,381 installments paid. So now let's return back to December 31st, 2011 year. So we need to know this amount, the installments paid, the 7,381, how much will go to repay the loan and how much will go to repay the interest. So this amount will be divided upon part to repay the interest and part to repay the original loan. So now we need to calculate how much out of the 7,381 will be repaid, will be used to repay the interest. To calculate it, we need to follow this rule, which is A. We need to multiply column A, this one, times the interest rate. So now we have the amount of the loan, $25,000. We need to multiply it by the given interest rate in the previous slide. It was given by 7%. So this means that 1,750 will be paid as an interest during this year. So we need to know how much remaining amount out of the installment will be used to repay the original loan. So the total installments is 7,381. 1,750 out of this will be paid to repay the interest, so the remaining will be used to repay the original loan. So in order to calculate column D, you have to multiply column B minus C. You have to subtract column B minus column C. So we are going to subtract the 1,750 from the 7,381. You will get 5,631. This is the amount remaining from the installments that will be used to repay part of the loan. So now we need to know how much is remaining at the end of this year. So in order to do that, you need to subtract column A minus column D. So column D is 5,631 minus 25,000. You will get 19,336. So we are going to subtract the value of the loan at the beginning of the period minus part of the installments used to repay the original loan. This means that we have 19,369 remaining from the loan. This is the value of the loan at the end of the first year. This will be the value of the loan at the beginning of the year, of the next year, of the second year. So we already fixed the amount of installments paid each year. It's fixed by 7,381. So now we need to know how much will be paid as an interest. So we will multiply the value of the loan at the beginning of the period minus the 7%, the interest rate given in the previous slide. So we will get interest equal to 1,356. So this is the amount used to pay as an interest. How much remaining from the total installments that will be used to repay the loan? So we will subtract the interest expense of the second year from the installments paid. You will get 6,025. So how much is remaining? You will subtract the value of the loan at the beginning of the period minus column D, column A minus column D, you will get 13,344. This is the value of the loan at the end of the second year. So this will be the value of the loan at the beginning of the next year, of the third year. So I will use it as the beginning value on the third year. So again, how much will be paid as an interest? You will multiply it. You will multiply the value of the loan at the beginning of the third year times the 7%. You will get 934. You will subtract it from the total installments paid. You will get the value remaining will be used to repay the loan, which should equal to 6,446. Then the value remaining at the end of the year, you are going to subtract column A from column D. You will get 6,897. This value will be the end value on year 3 and at the same time the beginning value on year 4. Again, at the last time, you will multiply it by the interest rate 7% to know the value of interest expense on year 4. This should equal to 484. You will subtract it from the total installments paid and you will get 6,897. Subtract A from D, you will get finally 0. So this means that the total value of the loan has been repaid over the 4 years. So this is the amortization table used to determine each year how much the Randa will repay out of the original loan and how much will be paid as an interest expense. Now let's continue to solve the second requirement, which is prepare the entry for recording December 31st, 2011 payment and December 31st, 2012 payment as well. So in order to solve this table, it's very useful to visit the last table that we used, which was the amortization table. So I pasted here for you in order to be able to visualize the number that we will use here. So what happened on December 31st, 2011? If you look here at the below table, the total amount that Randa will pay will equal to 7,381. So this is the total cash that Randa will pay. Part of this installment will be used to repay the interest, which will be 1,750. So you will have to look at column C to know the interest expense. And part will be paid to repay the original liability, which is the 5,631. So this means that you need to prepare an entry on December 31st to record two things. The amount that Randa will pay as in cash, so this will equal to the total installment paid, which was equal to the 7,381. This 7,381, part of it will be used to pay an interest, and part of it will be used to repay the original loan. So we need to record two things. The interest expense on this year, on December 31st, 2011, the interest expense is given as column C here, 1,750. And this means that Randa will record increase in its interest expense by debit 1,750. Then the remaining amount of the 7,381, the cash, is represent a reduction in the value of the loan, reduction in the original amount of the loan. So this Randa will treat it as reduction in its liability because she repaid part of its liability. Remember that when Randa borrowed the loan, she credited the liability, she credited notes payable by $25,000. Now she needs to debit the liability to indicate that part of its liability decreased. Why it decreased? Because by the time she will repay part of the loan each year. So now Randa will debit the notes payable by 5,631. This is column D on the second year, December 31st, 2011, to represent that it repaid part of the loan. When she will repay part of the loan, then its liabilities will decrease. So this is the first year for December 31st, 2011. Now we need to do the same for 2012. So we are going to visit the third column in the below table, the third row in the below table. So the total cash paid will still equal to 7,381. This is the total cash paid each year. Now we need to know how much of this amount will go to repay the interest expense and how much will go to repay the original loan. So the interest expense is given for this year equal to 1,356. So you have to look at column C here, 1,356. So should we record this as debit interest expense? Now, how much will be remaining to represent repayment of the original loan? This will be the difference, which is here, column D. You can see it as 6,000. Let me highlight it for you, 6,025. So this will represent reduction in the borrower notes payable. Its liability decreased because by the time she is going to repay part of the loan. So now Randa will debit notes payable by 6,025. So we have another case in which we can use the long-term notes payable, which is called mortgage notes or mortgage bonds. This represents a case when a person would like to go to the bank in order to get a loan in order to buy a house. In this case, the company, the bank will make the borrower sign a note. This note we call it mortgage notes, or what we call in Arabic الرهن العقاري. So in this case, if the borrower will fail to make the required payment according to the agreement, the bank will have to get his money by taking the assets of the borrower. So if the borrower has another car, has another home, has another land, so in this case the bank will take those assets from the borrower because the borrower failed to make the repayment. So what is mortgage notes and bonds? This is another type of long-term notes payable in which there is a legal agreement between the borrower and lender. So here it includes borrower promise to transfer the ownership to specific assets if the mortgage isn't paid on a schedule. So if the borrower failed to make the payment on a schedule, the bank will get the assets or will take the assets of the borrower. So mortgage payable are a type of long-term notes payable that are secured with the specific assets. They are included in the balance sheet like the notes payable as part of the long-term liabilities. So let us now discuss the third type of the long-term liabilities. So far we have discussed bonds, long-term notes payable. Now we will include the third type, which is pensions and leases. So now let us discuss the third and the last type of the long-term liabilities, which is leases and pension. We will start by leases. Let me first identify what do we mean by lease. Lease is a contractual agreement. It's a contract between two parties. The first party is the owner of the good, that we call it here lessor, and the lessee, the one who's going to rent the good. So this is an agreement between those two parties, the owner and the renter, that grants the lessee, the renter, the right to use the asset for a certain period of time in return for a certain amount of cash that he will have to pay to the owner. So here we have two parties, the owner of the asset, that we called him lessor, and the one who's going to rent the asset from the owner, that we're going to call him lessee. There is an agreement between them. This agreement is called a contract or a lease contract. So we have here two types of leases. One that's called operating leases and the other type that's called capital leases. The difference between them is the period of time. So if I were going to make a contract for a long period of time, which is actually more than 1 year, I will call this capital lease. If I'm going to rent another asset and then I'm going to make a contract for a period of less than 1 year, then I'm going to call this operating lease. So operating lease stands for renting an asset for a short period of time, usually maximum 1 year. Capital lease stands for renting an asset for a period of more than 1 year, so that's why we call it long-term or capital lease. So let us start by operating lease. So operating lease are short-term or cancelable leases in which the lessor or the owner retain the risk and reward of ownership. Example include most car and apartment rental agreement. So here what will happen? The owner, let us take an example. The owner of the apartment will rent it to another one. So the owner, we call him lessor, and the rent, we call him lessee. So what will happen here? The lessee will rent the apartment from the owner and will repay him certain amount of money. So usually this takes the form of a cash. So here the owner will receive the cash. This cash we call it reward of ownership. So he's rewarded for owning this apartment by receiving cash. At the same time, he will bear the risk. So if anything happened to this flat, to this apartment, the owner of the apartment will bear this risk. So this is what do we call, or what do we mean by that the owner will retain the risk and reward of ownership. And at any time, he can cancel this contract as long as it's short term. So that is the first type. The second type, we call it capital lease. So this is long term. Actually, it's more than 1 year. And it is non-cancelable, so the owner cannot cancel the contract with the lessee. And the owner will transfer all the risk and reward of ownership to the lessee. Example include leases of airplanes and department store building. So here a company, let us take an example. A company will going to rent a building from another company. So the first company here will be the lessee, the second company will be the owner. So what will happen in this case? Usually the rent takes place for a period more than 1 year. Actually, it could be 10 years, 20 years, and 30 years. And in this case, the lessee will use this building, so it can use it to operate another company, and all the revenues will go to the lessee. All the revenues as a result of renting this place will go to the lessee. And as well as if anything happened involving risk, then the lessee will handle this risk, will bear this risk. So this is the second type, the capital lease. So let us discuss this exercise in order to differentiate between capital and operating leases. Lauren Wright, an employee of eTrain.com, leases a car at O'Hare Airport for a 3-day business trip. The rental cost is $350. So here we have the employee who's Lauren Wright. So this employee will lease a car. So we can call him lessee. The one who's going to rent the car or rent the asset, we call him the lessee. The owner is O'Hare Airport. So this is the owner, and this will take place for 3 days. So the first thing that you need to look at is the period. Since it is 3 years, so this means that this is short term, so this is, we classify it as operating lease. And he will have to pay $350. You need to prepare journal entry by eTrain.com, this will represent the lessee, to record Lorian short-term car lease cost. So now, from the lessee point of view, he paid cash in order to use this car. So this amount will affect two items, will affect his expense and will affect the amount paid as cash. So the lessee will record this entry, which will be the rental expense. This represents rental expense, so he will debit rental expense and he will credit cash, or in other cases it's not clear here whether this amount is paid using cash or not, so he can credit rental payable. So it will either affect the cash if he paid cash, so he will credit cash to indicate reduction in the cash amount, or if he will pay later, so this will increase his liability, so he will record this as credit rent payable. So this is the first case. So let us discuss the second case. Juicy Fruit signs a 5-year lease for office equipment with Office Solutions. The present value of the lease payment is $20,859. Prepare the journal entry that Juicy Fruit records at the inception of this capital lease. So now you need to look at the period. It's given 5 years, so this is classified as capital lease. So we need to record the entry from the lessee point of view. So here, the company, the lessee, will record it as an asset. It will treat the capital lease as if it will acquire an asset. So the company will debit leased equipment. So the company will classify it as an asset in its balance sheet. The lessee will classify it as an asset. And on the other hand, the company will record this as an increase in its liability. So the company will credit lease liability. So in a case of capital lease, the company will record this as an asset in the debit side, and it will increase its liability in the credit side. So let us now discuss the second type of leases and pensions. So we have something here that we call pensions, which is المعاشات. So let us define what is pension. A pension is a contractual agreement between an employer and employees for the employer to provide benefits or payment to the employees after they retire. So now, if a company will hire a certain employee, and this employee will work for a company for a certain period of time until this employee reach the retirement age, which is usually above 60. So after 60, after the employees reach 60 years, he will have to retire, to stop work and to set home. So until this will happen, when he reach 60, he will no longer be able to work, so he will stay home, and the employer, the company that hired him, will have to make him payments to secure his living. Those payments, we call it pensions. So maybe each month, the company will pay to him when he reaches the retirement age that amount. This amount, we'll call it pension. So this pension, from the company point of view, represent long-term obligations. So those obligations will spread over a period of more than 1 year. So the company will record this as part of its long-term obligations or long-term liabilities. And by that, we have came to the end of this chapter as well as the end of lecture 9. Thank you.